Focus. Ideate. Innovate. Enable.
Hello and welcome to this special show. The one bastion which Indian women have definitely stormed into and conquered is that of money. The pun is intended. The top Indian bankers today are all women. But my guest today is special. She's not just a top Indian banker. She is also at the top of a big foreign bank, the biggest foreign bank in India. My guest is Zareen Daruwala, the Managing Director and CEO of Standard Chartered in India. Zareen, thank you very much for joining us today. Well, first up, we are looking ahead into a monetary policy, so let me start this interview over there. The Reserve Bank has said that it is at neutral level, so they perhaps will not cut. But what about money in the system? Do you think the cost of money can get cheaper, rates can fall?
So Lata, I agree there's a lot of cash in the system, but if you look at from a banker viewpoint, we are paying 4% for the savings account. If you take cost to serve of 2% and then add the regulatory cost of CRR, SLR of 0.4, 0.5%, you're already at 6.5%. And then if you take the credit cost, which is 0.5%, you're already at 7%. So, and you see the prime lending rate of most banks, it's hovering around 8.2, 8.3. So clearly the headroom now to reduce is very low. The second thing is, if you look at the government small savings schemes, actually they are at, if you take the post office 5-year scheme, it is at 7.8%, recurring deposit is at 7.3%, SBI 5-year fixed deposit is 6.5%. So clearly already bank deposit rates are much lower than government scheme rates. So my personal view is the headroom for banks, is very low now.
Now, I take your point about the costs, but incrementally, you are saddled with a lot of deposits. I guess about 40-50% has gone back after the withdrawal limits were removed. What do you do with so much cash? Deposit growth is still running after the withdrawal at 12%, and loan growth is 4%. So, incrementally, do you think at deposit rates, do you think they'll fall?
So deposit rates again, unless we look at the savings rate coming down, really, as I said, bank deposit rates are really low. So, okay. But yes, there is excess liquidity and credit offtake has slowed down. So that is causing a bit of an issue. But also Reserve Bank has just lifted the limits on individual withdrawals recently. So one has to see whether some more money will flow out. If you look at pre-demonetization, there was 18 lakh crore of money in circulation today. I think it's about 12 lakh crores. So one has to see whether, some of this lifting of the withdrawal limits, whether that will translate to some more withdrawal of deposits from banking system into cash.
So your sense is that bankers will take a call on the cost of money, deposit rate, term deposit rate or lending rate only perhaps a month down the line? I mean, when can we expect a change, if at all?
I would say I see the room for change very little. As I explained earlier, the flexibility or headroom is very little for the banks now.
Okay, let me come to, loan growth and economic growth itself. One of the big changes in India has been that political stability, and the state elections have reinforced it. Do you think that could be a catalyst for loan growth?
I think loan growth is a function of many factors. So one is how much excess capacity do we have in the country? So today we have 72% capacity utilization if you take the core sectors like steel, cement, power. So, and if you look at 2008-9, before we saw the whole capex cycle come, it was at 82%. So clearly the imperatives for capex are low. Second, if a company wants to do capex, they might as well buy a stressed asset at some good valuation if there is an asset available, rather than take the greenfield route. The other thing that is there which can spur capex is the public sector enterprises. They are sitting on 3 lakh crore of cash. And if you were to even lever it one time, you can actually have a momentum of 6 lakh crore of capex happening. So if you look at our gross capital formation ratio, it's really low. It's come down much, I think about 5-6 years back, it's come down by 7-8%.
Absolutely.
And if you look at China, it is more than 45%. So clearly, I think there is headroom to do capex provided the public sector expenditure precedes private sector capex.
Speaking about public sector itself, the budget has been restrained in its fiscal deficit, and perhaps rightly so, good for the bond markets. But do you see signs of, more roads getting bid out or railway orders? Do you see a public sector push to capex?
Actually, roads we've seen very good momentum, Lata, compared to 2 years back. The other good thing in the road sector, two good things that have happened in the road sector. One is that a lot of the stuck projects have been resolved to the satisfaction of most stakeholders. And wherever they were not moving, the government has taken the option of rebidding those projects. So I think that's a very good thing that has happened. For the EPC companies, one very good thing that the government did was that wherever money was stuck and there was an arbitration award, actually the government said if the bank gives a guarantee, the money can get released, 75% of that. So that's another very good thing that has happened, which has enabled EPC companies to get cash flow. It has started early days, but some of them have started getting the cash flow to be able to rebid for a few of the projects, because earlier the issue was that while you will bid out the projects, there should be enough EPC companies to do the projects.
Exactly.
So I think road sector, I would say great momentum coming back. Railways again, clearly where we see 2 years back, I think there's been a great move. To my mind, a lot more can be done because the multiplier effect of roads and railways for the economy is very high. And the third sector where public sector spending can really give a good momentum is defense. The public-private partnership, which can really give a big fillip. I think that kind of spending, and all these sectors, the numbers are big, which can actually kickstart. And when I was talking of public sector spending, even the PSUs, if you take the oil companies, they're sitting on a lot of cash. Really, that can be leveraged to, have a lot of transmission effect.
In 2007, we were looking at the roadmap opening up in 2009, and foreign banks allowed to either buy Indian banks or not have any controls on branches. Now, what is the growth scenario? Are you really that dependent on branches? Do you think growth is better or is it less?
So Lata, as foreign banks, we hardly get branches. Maybe amongst all foreign banks, I think about 20 branches are given. So that really doesn't give us many branches per year.
But is that a constraint now?
So I would say thanks to digital, it's much less of a constraint compared to a local bank. But then you're competing with banks who have 1,000, 2,000, 3,000 branches. So it's clearly not an equal kind of competition. But having said that, I think digital is really helping us as a foreign bank. We are working on the entire end-to-end digital journey. We'll be launching it this year, and where it will be virtually real-time onboarding of clients. All this is enabled because now we have a lot of digital infrastructure created by the government. So we're able to do a lot of things at the back end, where we can scrub the CIBIL database electronically, we can do the Aadhaar verification electronically. So you can actually onboard a customer very quickly. And to that extent, for asset acquisition, I think branches are no longer needed.
Even very retail customers.
Yeah, retail customers. You'll need an underwriter for a mortgage in a particular location to be meeting the customer, doing document verification. But for personal loans and credit cards, I think you really can onboard a customer very quickly. On the liability side, I would say is where a customer still wants to see a branch. So while you may not need a huge number of branches in a city, you will need a few branches, because the customer wants to, in time of crisis, wants to see a branch. He may never come for 2-3 years, but in that once in 2-3 years, he'll want to come to your branch. He'll need that safety or assurance that you are there physically.
Do you think that, this digitization is all set to take a leap? We have a large amount of illiterate population and not too well off as well. So do you think, say, in 2 years from now, do you expect digital to be big?
I certainly feel so. I mean, if you see the way the public is embracing digital, whether you take IMPS or UPI, despite UPI just being 2-3 months, we've seen, I think, 4 million transactions or something. So it's massive volume of transactions that we are seeing. Adaptation by customers is very rapid, with India having crossed US in terms of number of smartphones. To my mind, it's going to be a game changer.
Okay. Well, we have to take a break, Zareen, but there are the larger questions that the industry is faced with GST. It's a big exercise for the banks as well, stressed loans. All those questions to Zareen Daruwala in a minute after this break. Welcome back to the CNBC TV 18 special. My guest is Zareen Daruwala, the CEO and Managing Director of Standard Chartered in India. Zareen, now, the banking sector is now, I understand, going to need 36 registrations because of GST. How do you see this? Do you think this can be extremely disruptive? What would you want from the government?
Yeah, so Lata, if you see, most countries, actually, whether you take Australia, New Zealand, Malaysia, Singapore, they have only central registration, and GST is only on fee. So when you look at India, I mean, if you take SBI alone, they have 2 crore transactions a day, and the banking industry has 10 crore transactions a day. So if you take a month, I mean, the size is mind-boggling. Second issue is that the whole banking system, the core banking systems that have been developed, is with the understanding that customer has to be agnostic. He can be serviced by any branch, it does not matter. So the whole way the banking technology is built is on the premise that he can be rendered service anywhere. It's anywhere banking. Now, actually in GST, you are actually wanting to know where is the service being rendered. And the other problem will be for the banks is that you can record from the customer once. Now, if 2 states claim, so suppose the regional office claims that this is where, that state claims that this is where the service is given, and the head office one claims, you will be getting into endless litigation about, and you can't go to the customer and record the money. You can't debit him twice. So the banks can really run the risk of either litigation or going out of pocket. And the multiplicity of transactions. And also till now, we were just subject to service tax, which was one single
exactly. one point
tax. So it just makes the whole thing very, very complex.
I guess the system will have to be coded into, absorbing all this. Or
and Lata, one more thing is that public sector banks have to do an RFP. For them, just doing an RFP is a 30 or 40-day process, and we are talking of July 1. So it is, and a lot of the things are still not very clear in terms of, some clarity is still coming. So till you have the full clarity, getting your systems designed.
So in the very least, before April 30th, you all should have your fitment and rates and the details in place.
So that is really, really worrying for the banking industry.
Do you think we are going to see some big loans, say in steel or in power, getting resolved in 2017? I know these take time, but this is a long time.
So actually, Lata, in certain sectors like steel, I'm aware that the government is very proactively working on some of the large cases along with banks, and they are working towards the resolution. I think if you just take the steel sector and some 5-7 cases, it can solve 1 lakh crore kind of problem size of NPA or restructured asset. So it's really good that this progress is getting made. Having said that, I think the big issue for banks, public sector banks especially, is I think the Jan 23rd episode has put a little bit of a dampener in the decision making. And also we need more overseeing committees because it's just one committee. I think the number of cases that are there, I think we need more committees.
Well, just for those who don't follow banking day by day, Jan 23rd was when a few bankers were arrested for the Kingfisher case. How forthcoming has the Reserve Bank been? I know Mrs. Bhattacharya told us that you'll have gone to RBI with some tweaks in the corporate debt restructuring mechanism. Are you seeing any early, resolution, improvement in the resolution or changes to the resolution mechanism?
So Lata, actually if you take the three schemes of restructuring, SDR, S4A and CDR. So SDR you can do change of management, S4A has restrictions. So if I have to look at sustainable debt and unsustainable debt, the sustainable debt is linked to last 6 months cash flows and next 6 months. Sometimes in a stressed company that doesn't stack up, though actually on a steady state it would. And the other complexity in CDR mechanism is you can convert debt to equity only of 10%. So if theoretically I want to do a debt to equity conversion of more than 10%, I can't do an SDR if it doesn't stack up, the cash flows don't stack up. Neither I can do in CDR. And I may not want to do SDR where I change management. I may just want to do it with the existing promoter. I may want to convert 25%. So the issue is that if you want to do resolution which is tailor-made, sometimes it's not falling within the schemes, and that's when Mrs. Bhattacharya has alluded to that point about changing a bit of tweaking. If you look at the last cycle, actually CDR mechanism, all the restructurings were very tailor-made to the situation.
The other parallel solution that people have been talking about is bad bank. It has got strong proponents and strong and pragmatic opponents as well. You think we should go down that road?
So before we get to bad bank, I think we should step back and say what is it that is causing the issues. I think 2-3 big issues. One, as I mentioned, there are post Jan 23rd,
the fear of being called a crony or an IFID.
The CVC, CBI, all that is, I think, having a big bearing in the decision making of bankers in the public sector. The second, I think, issue that has been plaguing a lot of the decision making is very often in a large case you have more than 20 bankers. Just to bring consensus amongst all banks is becoming an issue. And the third problem that you face is that for every asset that you want to sell, the buyer will be looking at 10 such assets. So there are very few buyers and more sellers. So this is the scenario today. Now, having said that, I think a bad bank works if we do certain things. One is that we have to quickly do it. If we take 1 year to set up the bad bank, what will happen is the clients will suffer because for that 1 year decision making may get slowed down. The second thing is where do you get the capital and how do you because then
staff it.
So suppose theoretically the bad bank has a structure like a ARC where they issue SR, security receipts. Then you again have for the bank 150% risk weightage on the SR. So you not in a way then solve for the capital problem of the bank. Unless you empower this bad bank with the legal and whatever teeth that they want, it is not going to happen. Then the whole essence of doing in a time-bound manner, if it's not happening, then even the bad bank will actually sort of go down the same route. So if you do some things, yes, it can be successful.
I don't want to wind up this interview without asking you one thing. You have so much of rich banking experience. You were in a Indian banking setup, Indian private bank in ICICI at the helm, and now you are absolutely at the top of a foreign bank. What's the difference, Zareen? Is it a big difference?
No, I mean, Stanchart has been in the country for 160 years, and in fact, everybody is an Indian who works here. So, to that extent, culturally, it's very much like any other Indian bank. Having said that, I think there are 1 or 2 differences. In ICICI, we had one regulator, Reserve Bank. Here, I have dual regulators. And in a foreign bank, like most foreign banks, you have a matrix structure of reporting where most people have dual bosses. Though I have one boss, but a lot of my people have dual reporting, maybe hardline to me and a dotted to somebody else, etc. So that adds to the different style of functioning of two different banks.
Okay. But, we still have you in the banking system, and that's very important. We don't want Stan Shah to take you away out of India. Thank you very much, Zareen Daruwala, for speaking to me today.
Thank you.